Everyone. Welcome to Chart This with Dave Keller. Happy Thursday, June 26th. I am your host, Dave Keller, coming to you from a actually beautifully comfortable Redmond, Washington. High today around 71 degrees, I want to say. Hope those of you in the Northeast and Midwest and other places with the sweltering heat are keeping cool and getting some relief from the extreme temperatures. We've been very much cushioned from that experience here in the Pacific Northwest. It's absolutely lovely. And I hope you get this kind of weather very soon, wherever you're at, because it's quite enjoyable. Sorry for the late kickoff today. I was actually finishing off what ended up being an extended podcast interview with Mike Webster. Webby is one of the, bedrocks of the IBD team, Investors Business Daily. He worked with Bill O'Neill back in the day and created a lot of the tools and techniques. If you've read Investors Business Daily or you use Market Surge or any of their platforms, all the cool quantitative stuff, some of the really interesting, techniques that have been incrementally added to the platform. Mike came up with those over the years. So really, really fun to talk about how he created things like the IBD composite score, how he thinks about risk when they designed Swing Trader, which is a successful product that he still helps run to this day, what their goal was, how they've adapted it, what he's learned in 2025. The conversation just kept getting good, so I didn't want to cut it off. So did mean we have to start a little later today. Sorry for that. But that episode should be ready for you probably tomorrow morning. I hope you can enjoy that when it's out. Check out on my podcast my latest episode with Callie Cox, the chief market strategist at Ritholtz Wealth Management. I caught up with Callie earlier this week. Some really cool sort of investment words of wisdom, how to think about diversification, concentration, know what you own and why you own it was one of my favorite quotes that she shared in our conversation. So the podcast is going well. I hope you're able to check it out. Speaking of things going well, the market's pretty bullish here. I tell you what, I mean, as much as I can keep finding things that concern me about this market, hopefully what you've heard me say many, many times is at the end of the day, the market doesn't care what you think, follow the trend. This is why I have a market trend model that I don't subjectively interpret. It's very straightforward. It's either bullish or bearish on 3 different time frames. The market trend model has been bullish on all 3 time frames since early May. It remains bullish on all time frames to this day as we are briefly trading to new all-time highs earlier in today's session. That's what tells me this market is innocent and so proven guilty. I'll continue to look for things that could be signs of weakness and hopefully articulate what I would look for to validate a pullback scenario. The trend is your friend, and the trend overall continues to be positive. With that in mind, let's check out some of the charts and see how things are playing out. As a reminder, I can see questions coming in on Facebook, LinkedIn, YouTube, and X. If you're tuning in live, I appreciate you doing so. Drop a question anywhere where you can put a comment in. I can see all of those here from the live stream platform. I'll take a question or two at the end of the live stream. Anything we don't get to, we'll put it in our mailbag. I already have a couple really good questions pulled aside from the feedback this week. Looking for a couple more. So ask questions all along the show, and hopefully answer one of yours on the show tomorrow. Here's the S&P 500 pushing just above 61.45 just before the close. We closed around 61.41. That's enough for the S&P 500 to be up 0.8%. The NASDAQ Composite up about 1%. Small caps, the best performers, up 1.6%. Mid caps up as well. The VIX continuing to move lower, not a ton, slightly lower today. So around 1659 or so. And, 16 handle on the VIX basically means a low volatility environment. In this sort of environment, you sort of look for indicators that define the uptrend. Look for indicators that confirm that conditions are good. VIX remaining below 20 is one of those things. VIX popping above 20, again, not the end of the world, but definitely tells me, okay, we are now entering a volatility regime where a more significant pullback is definitely in the cards, potentially. Not in this environment with the VIX remaining below 20. We're in a low volatility environment. Market's telling you not much to worry about here, and the volatility is in line with that. We're going to look at the chart of the dollar a little bit later during the chart review portion of the show. The dollar index moving lower again. We're making new 52-week lows this week. Today in particular, we made a new low for 2025. That weaker dollar can mean a lot of different things. And I'm often asked about what a weaker or stronger dollar means. The short answer is it depends. There's so many things that kind of influence the value of the dollar. It can mean very good or very bad things at different times. So I think with something like the US dollar, it's all about context, right? And when we look at the chart of the dollar, we'll talk about what a weaker dollar means, I think, in this scenario. But I'll show you some charts that support that. Rates continue to move lower. Bonds were higher today. So you had stocks higher and bonds higher. The TLT was up about 0.5%. That means rates are coming down. The 10-year yield is right around 4.25 at the close. The long bond yield just above 4.8%. And the 5-year point has gotten down to 3.8%. So rates are coming down, and rates are coming down, which basically means certain things are getting a lot more, I would say, encouraging, right? And the set of charts that immediately come to mind when I see rates trending downwards are home builders. I don't know if I grabbed a chart of home builders. I don't think I did, and if not, I'll try to remember to grab one. Because home builders usually have a pretty good relationship with rates. Because when rates are overall moving higher, that means your mortgage is way more expensive. That means you have to buy less house, or it's just not a great time to try to buy a new house because your mortgage is going to have a much higher rate. When rates continue to come down, that means things become less expensive. That means you have an opportunity to the home builders could be in a really good setup phase because people that maybe have been waiting to take on a new home purchase maybe feel more incentivized to do so. Grab the chart of the 10-year yield. We'll look at that as well. Commodities kind of mix here. You can see gold finished slightly lower. The GLD was down just 0.1%. Earlier in the day, right out of the open, gold actually opened quite weak. Actually ended up trading up to yesterday's close. We can see here right after lunchtime Eastern, pulled back a little bit going into the close. Silver, copper prices both higher. Crude oil prices a little bit higher, and the energy sector back to the top of the leaderboard. Cryptocurrencies, you can see a choppy day for Bitcoin. The last 24 hours have been kind of choppy, sloppy in the 107 to 108 range. Overall, I would say the chart of Bitcoin pretty constructive. It's definitely stalled out here. I'm curious if it makes the most sense, which I think it does, to label the chart of Bitcoin as in a potential bull flag pattern. That's when you have a big run higher, you have a pullback of lower highs and lower lows, little flag-shaped pattern. When you break out of that flag, that implies much further upside. Bitcoin needs to get above like 109,000 to complete that bull flag pattern and breakout. If and when we see that, I'll show you that chart and what it means. But that's sort of the upside signal I would be looking for. Move above 109,000 or so would take us out of the bull flag and confirm, I would argue, a pretty bullish outlook for Bitcoin in particular. All right, looking at the 11 S&P sectors here, we can see energy number one. The XLE was up 1.4%. Communication services number two, up 1.2%. Materials number three, tied with industrials, up about 1.1%. So the top of the leaderboard, the MEI trade. This is a group of cyclical sectors, kind of economically sensitive sectors, tend to do well kind of in the mid or later period of a bull market phase. So MEI, meaning materials, energy, and industrials. They don't always move together, but that's sort of a group of companies that do well when the economy is doing well, or at least the expectations of economic growth are there, because it's raw materials that you use to build stuff, it's industrials that are actually building stuff, and it's energy requirements to fuel things we're trying to do. And that's why they tend to do well when conditions are good. For now, they're at the top of the leaderboard, which is pretty compelling. On the downside, you have real estate at the bottom of the leaderboard, down 0.6%. Consumer staples basically flat for the day. Sorry about that. And then you can see healthcare, third from the bottom, up slightly, about 0.25%. Breadth pretty good today. So we highlighted yesterday that the breadth was not particularly good. And so it's been sort of one day to the next. You see big upswings and big downswings in breadth. Today is one of those good days. I love, the stock charts platform is not perfect, but there's a lot of really good parts of it. And it's become so central to how I approach the markets every trading day. And I love this visualization with breadth. And it's color-coded green if the number is generally bullish. It's color-coded red if it's generally bearish. You can see that simple color coding system at the bottom. You can see that the breadth was pretty good today. So on the New York Composite Index, a 4-to-1 ratio of advancers versus decliners. In the S&P 500, a 3-to-1 ratio of stocks going up versus going down. The more you have days like that, the more that it suggests that the uptrend is in good shape. If we see the market keep going higher, but you see days like yesterday, which was a much weaker breadth scenario, that's where you want to start to be concerned. So keep an eye on there for sure. For now, breadth is good. Looking at the Magnificent Seven and Friends, Netflix, Meta, Amazon, the 1, 2, 3 punch at the top of the list, all up just over 2.4% for the day. Strong up day for those names. And I would say chart like Amazon, charts like Meta have been pretty good for a while, just kind of breaking above resistance. Amazon is one of those that was sort of not following through as much as the other Magnificent Seven names. So super encouraging to see that chart in particular starting to break out. The two charts that did not work today are probably the two consistently underperforming or questionable charts. Tesla, which has been a noisy, chart, but that bounce we had because of the robo-taxi rollout in Austin, and the headlines on that day were like, robo-taxis are going to be everywhere. They're amazing. It went really well. The chart of Tesla has now given back all of that robo-taxi bullishness and a little bit more now, with today's drop of about 0.5%. Apple also kind of consistently underperforming the rest of these growth leadership names, down about 0.25% today. I think that's it for the first page. Shall we look at the market carpet? Look at some heat map style visualization. As a reminder, I do see some good questions and some comments coming in on the different live stream platforms. Please keep them coming. We'll take a question or two at the end of the live stream. Anything we don't get a chance to address on the live stream, or if you're watching the replay on our YouTube channel, just put a question in the comments section. We'll gather some of those great questions we didn't have time to get to and answer it on tomorrow's all mailbag episode, which is one I always enjoy. It's a joyful one for sure. All right, looking at the heat map, pretty decent update, right? And I would say most sectors on average having a decent amount of strength. I'm immediately drawn today to the strength in communication services. The three biggest sectors, Alphabet, or the three biggest stocks in communication services, Alphabet, Meta, and Netflix. Meta and Netflix, the two top performers. Alphabet up about 1.7%. That's pretty good. The reason why I always focus on those top names, by the way, and I'm bringing up the data over on another screen. Those three stocks make up a ton of weight. So Meta is about 19% of the XLC. Alphabet's just under 10%. Netflix is around 9%. Alphabet's other listing is about 8% because there's two. There's the A shares and the C shares, which are both separate listings. So between those three, that's what, 24, 25, 40, almost 50% of the XLC are those three stocks. So that's why the XLC does well when those names are doing particularly well. It's a huge jump down from like Alphabet and Meta down to like Warner Brothers, right? I mean, it's not even registering on the chart of the XLC necessarily. It's those big names. That's why we tend to focus on the mega cap stocks so commonly, because that's pretty valuable. So the three biggest names in communication services having some of the three best days, and that's pretty encouraging. Also noting in consumer discretionary, Amazon is an important chart. I'm pretty sure I grabbed that one. I hope I did. Let's make sure I did. I thought I did. Good one to review because I think it's just potentially breaking out here. But also want to highlight some of the other ones. Booking and Royal Caribbean are two that come to mind, both, threatening new all-time highs today. If you follow my work on CNBC Pro, wrote about cruise lines. My producer at CNBC, who I work with to get those articles published, he asked if I was going to mention the Poopy Cruise, the Poop Cruise documentary on Netflix, which I did not. That was Carnival Cruise Lines, by the way, but I have not watched it. I saw the preview for it. I was like, oh, I really need to watch that one. But no, that did not come up in my technical review of Royal Caribbean cruises. But the chart has been a pretty interesting setup. The article that I put on CNBC Pro addressed some point and figure analysis, which is probably something I feel like I don't talk about enough. But a classic double top breakout sort of an exclamation point to the rally that we've seen here. Also noting Booking.com right at a new all-time high, sort of testing the swing high from earlier in June. Nike's another one. Nike's an earnings name today, I believe. Yeah, reporting after the close today. So, interesting setup here, right? And a chart like Nike, I hesitate taking a position going into earnings, particularly if you're more of a swing trader, because I think that's a dangerous, binary move. From a technical perspective, it's not a bad chart. A bad chart is we're making lower highs and lower lows. A good chart is we're making higher highs and higher lows. But for me, a good chart is also above the 200-day moving average. And so Nike's sort of in that meh category where it's not going down. It's sort of stabilizing. The RSI has been between 40 and 60 for the last 8 to 10 weeks. So it's an okay chart at best, I would say, right? It's an okay. It's a neutral rating, I would say, if I'm sort of ranking the charts. Nice bounce in the after hours, though. It looks related to earnings. So it's currently trading around, what do we call that, like 66. So it's actually currently trading around here. And if that would happen, that would be a nice breakout above the swing high. That's a dark cloud cover candle that we highlighted in mid-June. It would be breaking above 65. I think that would be good. I'm one of those guys where I would be waiting for a break above the 200-day, because I've seen a number of these times where we trade up to but not through the 200-day moving average. However, I'd love to see a breakout above that point. That would be more ideal. We'll see if the optimism coming out of earnings is enough to get us there. What else can I highlight? Financials remain kind of a mixed bag. Berkshire Hathaway continuing to not participate in this uptrend phase. If you start the clock in early April to early May, Berkshire Hathaway was kind of rallying along with everything else. But from that moment on, it's been deteriorating. And Berkshire Hathaway currently testing a new 3-month low. That's a regular screen that I look for. Stocks making new 3-month highs, stocks making new 3-month lows. Berkshire Hathaway is one of the few individual names that I bought in a retirement account years ago, and I'm just holding it for the long term. Not thrilled at the deterioration from 540 down to 490. That's what, an 8 to 10% drop off of all-time highs. While the long-term trend is still good, on the short-term side, the fact that it's not participating in this uptrend, I would argue, is not an ideal sign. But look at some of the other charts in financials. Goldman Sachs making a new high. Blackstone, while not making a new 52-week high by any means, is kind of getting closer and closer to looking like a pretty decent chart. It looks kind of like Nike, right, where it's kind of bounced up and then stalled out. Momentum more neutral. And the question is there enough momentum to get above there? I think this is an exceptional chart above 156, which would clear the 200-day moving average. We'll see if it can get there. For now, nice bounce higher today. Last thing I would mention would be within the energy sector. And as much as like Exxon and Conoco are jumping because crude oil prices are doing okay, I'm much more intrigued by some of the pipeline names. I had an interview a number of months ago. I want to say this was a while ago. I'm going to check and see exactly when it was. But this was one of the few episodes of the Market Misbehavior podcast really focused on the energy space. Talked with Rob Thummel, who's a portfolio manager at Tortoise Capital, which is really an energy-based portfolio management group. And we talked about how some of the best charts aren't in the big integrated oil companies or in oil producers, exploration, we call the E&P stocks, is in the pipeline companies. And I'm looking at Williams making a new 52-week high today, breaking above previous resistance. So strength in energy, but it's in some of these other ones, like Williams, like TRGP, Targa, making a little brief rotation higher. So keep an eye on those infrastructure names. Apparently starting to improve a little bit. Caterpillar's another one, by the way, rotating higher. So, as you're looking at these charts, I mean, there's so many charts that are breaking out of resistance levels, that are breaking to new 52-week highs, in some cases breaking to new all-time highs. As always, I have like a skeptical lens with which I watch these markets, these stocks breaking out. And I would say the way that I approach this kind of market, and hopefully you've picked up on that, but if you've watched the show for any period of time, number one, identify the trend. These are the three things I try to do every day. Number one, identify the trend. The trend in the markets is bullish, to be clear, and it has been for a little while now. Number two, follow that trend as long as possible. So I think once you've identified an uptrend, hopefully taken a position, do whatever you can to participate as long as possible. Peter Lynch talked about watering your flowers and pulling your weeds. This is the watering your flowers part of the argument, right? Stick with things that are working. So how do you, when do you know to pull your weeds? Well, you have to wait for that flower to die, which means the uptrend is no longer working anymore. So I'm always looking for signs that we might have a downside rotation. And that's why we've been talking about breadth and momentum deterioration, other signs that maybe the uptrend is not going to continue. But to be clear, the first rule is the most important. Follow the trend as long as possible. I'm seeing a lot of good breakouts right now as I'm scanning through the equity universe. We'll keep going here in a moment. Look at a bunch of charts together. Before we get there, just want to remind you, Seeking Alpha, longtime partner to the channel and a supporter of Market Misbehavior, doing their summer sale right now. If you go to my link, marketmisbehavior.com/seeking alpha, or scan the QR code that you see on your screen, you can see all the details. You get a 7-day free trial. They're kicking 20% off all of their products, from premium, which is how you get access to some of their best commentary and quantitative analytical tools. Pro, which is a higher level of service. Alpha Picks, which is where they hand select some of the names in their using their quantitative method and dig a little deeper. You get access to all that. Also, they just recently, I think it was last week, put out their second half of 2025 market outlook, presented in some way by Steve Kress, who's the founder of their quantitative operation. You can get access to all of that as a premium member. For more information, go to marketmisbehavior.com/seeking alpha. Gives you a little better deal than you would on your own and helps me make Market Misbehavior awesome. All right, let's keep going and look at some charts together. Sorry, I opened a bunch of things here. We'll start with the chart of the S&P 500. The chart of the S&P 500 showing the fact that we, on just the briefest of moments, made a new all-time high today. The S&P threatening 6150, which is where we hit in February of 2025. We have officially completely round-tripped from the February peak down to the April 2025 low, just below 4850, all the way back up to that February peak. It has happened. I mean, talk about an amazing learning experience. And one of the things I mentioned probably on the show back in here, the good news about bear markets of any duration and any severity is they present fantastic learning opportunities, right? I've learned bull markets are fun. It's great when stocks go up. I enjoy when the benchmarks don't go down. I enjoy when they go up much more, to be clear. But I learn way more in bear markets because you can get away with all sorts of bad habits when the market's going higher. You can get away with bad stock picking. You can get away with an underdeveloped risk management strategy because it doesn't bite you. In a bear market, all that stuff matters, right? If you have bad routines, it starts to really matter a lot. And so I found bear markets are where, as an investor, you really have an opportunity to grow. And that's good. That means in bull markets, your portfolio grows. In bear markets, your market wisdom grows. In any case, you're going to be growing as an investor. Hopefully, I can help you along that growth, that investing growth journey in any way. So zooming into the chart of the S&P 500, I added this sort of short-term support level on yesterday's show. I think the way you generally think of a market in an uptrend is you continue to sort of either literally or I guess directly or indirectly kind of keep bumping up your stop, right? You want to think of locking in those gains as long as the trend continues. Talk about following the trend. So use tools and techniques to follow that trend higher. When you're looking at something like the S&P, looking at recent swing lows, making sure those hold on a future pullback is a big part of the game. That's something Ralph Akampora taught me long ago. He said, when we're in an uptrend, don't worry so much about the highs. Like those are going to be fine, right? Don't worry about how much we're going up. Focus on the pullbacks. And as long as the pullbacks keep gaining ground, right? When you pull back, as long as it's not as low as the previous one, we're still in an uptrend. And just keep that in mind, which means the S&P over 5950 is a pretty strong market. And now we have room between 6150 and 59.50. We got about a 200-point swing before we would break that initial line in the sand, and that's why I would keep an eye on that. The momentum divergences that we highlighted here, as we talked about, the way that could be negated is if we break higher on stronger momentum. And it's looking more and more like that's the dynamic here going into the end of June, going into the 4th of July holiday in the US. Newer Dow theory, I just wanted to highlight the fact that the equal-weighted S&P 500, which is the top panel, and the equal-weighted NASDAQ 100, which is the bottom panel, both of those are making new 3-month highs this week. So when both of those popping higher, that basically is a Dow theory confirmed or a bull confirmed pattern when both of these indexes are making new highs. When one of them makes a new high and the other does not, that's called a bearish non-confirmation. It looked like that could be a potential scenario in mid-June. Now it looks like that scenario is off the table because both of these are now above their May peak. So I would say overall that's a pretty strong validation of the current uptrend phase. Sentiment data usually comes out once a week, at least the indicators I watch. The AAII survey, not much to report, so we won't spend much time on this. Slight uptick in bulls, slight downtick in bears. The spread between the two a little less severe. Bears still outnumbering bulls, but only by about 5%. So overall, I would say this is a no real significant change. It kind of remains where it's been from early May really to late June. We've had a consistent sort of spread between bears and bulls. So nothing really significant there. The name exposure index, kind of an interesting head scratcher here over the last week. Last week it was around 94% allocation. Today it's more about 81%. So money managers in this poll have actually lightened up, or have said they've lightened up in their equity exposure in the last week. So now again, some of that could still be reflecting some of the uncertainty over the weekend. I mean, it's been a busy week news-wise, from it appearing that the events in the Middle East were going to escalate to, a point of no return almost, of an escalating conflict, to all of a sudden looking like there's a ceasefire that's holding and hostilities have, significantly lessened. We'll see how that sustains and what new headlines we get out of the Middle East. But for now, equity managers in this survey actually lightening up a little bit. That's a story to continue to watch going into next week. Two macro charts I wanted to share with you, the 10-year Treasury yield and the US dollar chart. We'll look at each of these one by one. So bonds are rallying here, which is sort of an interesting dynamic. You have both stocks and bonds rallying, and that certainly can happen, right? I mean, if you think oversimplistic, I think a lot of people kind of oversimplify and think if stocks are working, right, we're kind of risk on. And if people get nervous, then bonds outperform, bonds up, stocks down. And generally that has been a phenomenon that has been the case in many market regimes. However, stocks and bonds can definitely move together. And that's actually a scenario that I've seen play out at times in my career as well. What you have to think about is it's a little more complicated than that. There are a lot of moving parts on here. I would say at this particular moment, rates are coming down. This could be in a number of different things, right? It could imply a lack of optimism about economic growth way down the road, right? Which would bring rates down as investors are kind of pricing in lower growth. So the short end of the curve is kind of remaining stable. The long end of the curve is starting to come down. This is what gets us to an inverted yield curve, which is implying a lack of optimism about economic growth. The economic data recently has not been remarkably strong. The consumer sentiment data has not been particularly robust. So maybe that's part of the thing that's being reflected here in lower rates. But for what it's worth, the 10-year yield is back below its 200-day moving average for the first time since the end of April. We've had 2 months of the 10-year yield above the 200-day. It's actually back below there. And we drew this trend line earlier this month, recognizing the fact that there was an uptrend in rates, and that has now started to change. So we could easily draw a trend line off of the highs, which is probably what I should do at some point. But for now, I'm seeing rates trending lower. And immediately I think of home builders, which tend to struggle when rates are in an uptrend, and tend to do a lot better when rates are coming down. That's a great tailwind for the home builder sector. So keep an eye on ETFs like the ITB and the XHB are good ways to sort of keep a read on that space. The dollar is also making new lows, and we can, again, I'll keep bringing people on my podcast and asking them what they think this chart of the dollar represents, and more in the macro backing of it. But I would say from a technical perspective, the dollar's in a clear downtrend, right? Lower highs, lower lows. We're below two downward sloping moving averages. So what does that weaker dollar mean? Well, we can debate a lot of reasons why the dollar, is going up or down, because it's hard to really know for sure what all is driving the differential between the dollar and other currencies, which is what this represents. I think it's interesting to note what some of the implications are. And I would say one of the things to remember with a weaker dollar, it tends to be really good for big mega national, multinational companies is the word I meant to use there. Big mega cap multinational companies. Why is that? If you're a company like Apple or some big multinational conglomerate type of company, not just in technology, but in other things, you get a lot of revenues outside the US, right? This isn't the story for like a US small cap company that doesn't have a lot of non-US operations. It's really only for, big companies with a lot of operations outside the US. You make a bunch of revenues in some other currencies, and then you have to convert it back to dollars. So when the chart of the dollar has done this in 2025, what does that mean? That means those non-US revenues are looking better and better. And when you convert those non-US revenues back to US dollars, because that's where your books are notated, your non-US revenues all of a sudden look a lot more valuable, right? Because they're worth more dollars. So a weaker US dollar tends to be really, really good for US multinational companies because their non-US revenues are more valuable in US dollar terms. The opposite happens when you have a strong dollar environment, because that's actually a headwind, because all of a sudden when you make a bunch of money in China or in Europe and convert it back to US dollars, those non-US revenues are less valuable. So this downtrend in the dollar, and we'll see, and the reason why I'm sharing this with you now is because I think this is one of those themes to listen for when we get to Q2 earnings reports, which are coming up here in a couple weeks, kind of mid-July to early August is when companies are reporting their second quarter earnings. And I would keep a watchful ear peeled for comments about what the weaker dollar environment, because that could be a really good boost for big multinational companies. And as you know, our benchmarks are dominated by big multinational companies. So the trend in the dollar at this point, I think, is probably really, really good news for some key stocks in the US. What that also means is this chart is super important, because at some point that downtrend is going to turn back into an uptrend. And all of those cool things I just said about why this is good for US multinational companies, the opposite also holds true. All of a sudden, it would be a big headwind. For now, it's good news. I would keep an eye on that theme when in a couple of weeks when we start hearing companies report their second quarter earnings results. Super Microcomputer, just want to highlight, this is on my 3-month high list today. I regularly look for stocks breaking new 3-month lows and stocks making new 3-month highs, because I think it's an important list to just look at and refresh and just make sure you know what's working out of all the universe of stocks that you're focused on. SMCI is breaking out. Now, this looks like a pretty normal chart. These are big percentage moves on the upside and the downside, because it's a huge price swing from $20 up to $120 up at the peak. So this breakout could be a pretty meaningful break. I think at this point, that suggests the February swing high, which is up in the upper 60s, maybe the next upside target for SMCI. Amazon really close to breaking out of a resistance range. One of the things we've talked about how charts like Meta and others kind of consolidating, even though the benchmarks are breaking out, stocks like this have been lagging behind, have not really been able to break out. Now, the chart of Amazon has some really interesting candle patterns. I don't have a candle chart here to show you, but this is not a perfect example. It really isn't. I hesitate to even say it. It's kind of like an evening star candle pattern. Here we have some long upper shadows. It's called a shooting star candle. So a number of times we've kind of gotten up to this 215 to 217 range, and we've had bearish candle patterns that signify a rotation back to the lower end of the range. We're back up to that peak. So I would love to see Amazon break out and get out of this range without some bearish candle pattern. That's why this chart, for now, nothing negative yet, but I'm keeping an eye there. Arista Networks making a new 3-month high as well. Today, gapping above the 200-day moving average, also powering above the May and June highs, also getting above big round number resistance. $100 a share is that level we're just breaking through today. On a chart like this, I'd want to see follow through tomorrow, but I think this is a really compelling breakout really would imply a retest of the previous highs, or at least back to 120, which would be the kind of lower end of that gap range back there from Q1. Finally, Freeport-McMoRan breaking out above a previous resistance. Probably call this a bull flag pattern that has resolved higher. But this move also gets us above $43, which means we are clearing the last Fibonacci resistance levels. I think FCX now pretty clearly a bullish trend upside to the previous highs around 52, which would take us back to the high from the end of the third quarter of last year. That's the last time we were up around those levels. But I think a nice breakout above the March swing highs. We've completed a move above the 200-day. We've broken above the Fibonacci levels. There's nothing left in terms of resistance up to much further upside. All right. Shall we take a question or two? I appreciate your kind comments about being a sane voice on the market. I appreciate that you think that. I hope that's true. I mean, it's so funny. A lot of people grade my show and my comments based on how well I've predicted different moves. If that's what you want to do, that is your call. My goal is not to be an amazing stock market predictor for all of you. My goal is to spur your thinking, to nudge you in certain directions, to help you focus on the tools and techniques that are going to help you make better decisions in your own portfolio. So if your portfolio is doing well, that makes me happy. It's less my great calls, of which I do have some. I also have some really miserable calls. The more you do this, the more you tend to have a lot of both, I would argue, in your rearview mirror. 3P Investor, thanks as always for watching, my friend. You said, I remember you interviewing Steve Kress on your show last year. It was earlier this year on the Market Misbehavior podcast, and we did dig a little bit into the Seeking Alpha quantitative models and methodology and their Alpha Picks product and all of that. But a really interesting one. I love talking with people like him. I would argue my interview today with Mike Webster, and again, that should be out tomorrow, hopefully. He really created a lot of the quantitative tools in Investor Business Daily and worked with Bill O'Neill to do so. It was a lot of fun. I love talking with people like that who have really helped to promote thinking about technical analysis as part of a broader process of understanding a company and relating that good companies don't always make good stocks. So having companies with good fundamentals and the ability to grow earnings that also represent good charts and have good, technical characteristics, represent strong momentum and outperformance, strong relative strength. I think that's the marriage you want to be looking for. And Steve did a great job of explaining how they do it. Mike Webster earlier today did a great job there as well. There's a really good question that I want to get to. Here we go. Patrick, thanks for watching live on YouTube. You said, what are the best indicators to watch that will show that an upward trend has ended? That is the question, isn't it? I'll give you a couple different ideas. So number one, I would say the way that you identify, so many people, try to make a lot of noise, and we celebrate people that allegedly pinpoint a top, right? They say to sell at the peak, at the actual day where the top is ticked. And it's amazing as time goes on, more and more people seem to remember that they had a perfect call at a perfect turning point. That's actually a well-documented behavioral bias called hindsight bias, which is as time goes on, our own memory of our calls actually gets better and better. We optimize how we made decisions in the past. And I think that's a way of making us feel better. It's right, nurturing our ego. That's what our brain is doing. But, again, while we celebrate those people that pinpoint the top, for me, the game is not about pinpointing the top or pinpointing the bottom, right? My goal is never to know on April 7th, this is the low, it's happening today. That is a fool's errand. And we don't celebrate all the people that call that way too early or call it way too late. We tend to celebrate these people that do it at the moment. I would say there's more luck involved than anything if that's something you're actually able to do. For me, it's more about recognizing when the picture has changed. So I would say for me, identifying a top is less about having a crystal ball. It's more about having a consistent routine of evaluating the evidence and recognizing when the trend changes. Because for me, the biggest problem you have is when the evidence changes and the market actually does turn lower, but you ignore it and you stick with something that had worked before, but all of a sudden the evidence is no longer supporting that. So I think having a consistent process of reviewing the evidence is so valuable. So having said that, What else do you do? What's the chart? Let's bring up something like NVIDIA. No, let's bring up something like, oh, it's not, it's good enough. All right. So what are the things I would look for? So I would say number one, moving averages are a go-to. I would say a couple things I will show you. Moving averages are really, really helpful in this scenario. It can be if it's something that's in a longer term uptrend, following something like the 50-day moving average is a really good point. I actually posed this question to Mike Webster earlier today. And he talked about exponential. He talked about the 20-day moving average. One of the things that I like looking at would be like a 21-day exponential moving average. Now, why an exponential moving average? Because it's more sensitive. So an exponential moving average basically means it weights the more recent data more heavily. So the problem with a simple moving average is all the data is weighted the same. So what happened today and what happened 20 days ago have equal importance. An exponential moving average, the more recent data is weighted a lot heavier. So what happened today is way more important than what happened at the 20, 50 days ago. Makes more sense to me. So having that short-term moving average as an exponential moving average to track the uptrend, and as long as we hold the 21-day EMA, I think things are pretty good. I think that's a great way to think about positions that you have. If you own something and you're just afraid of leaving it, of giving it all back if the market rotates lower, keep a watchful eye on the 21-day EMA and start getting out of it if that starts breaking. I don't think that's a bad thing, to be honest with you. There are more simple ways to do it. Something like a 7 to 8% drawdown from a previous high. So every time we make a new high, just keep an eye on 8% below that. Make sure we don't go anywhere further below than that. That can be an easy way to do it. I love for people to get to average true range. That is more of the ideal place you want to be, I would think, in terms of trailing stops. The chandelier exit, which is on the stock charts platform, and other platforms have this as well. Sorry, I've now completely confused the issue here. This blue line now, let's make that something we can actually see like pink. The pink line is the chandelier exit. This is a dynamic trailing stop based on average true range. Average true range is kind of a miracle indicator because it's dynamic. Average true range basically means what's the normal trading range for the stock, and true range means you adjust for price gaps. So if the stock gaps, that is included in your analysis of trading range. So it's how much does the stock trade on an average day, high to low, adjusted for price gaps. The reason why average true range is really good to use is because what you want with a trailing stop is you want it to be triggered when something significant happens. You don't want it to be triggered just when there's normal market noise, right? So by using average true range, you're kind of adapting for that. You don't get stopped out, or the idea is you ideally don't get stopped out when it's normal trading range, but when something more significant happens, it's enough to trigger the stop. So the chandelier exit system is a good place to be. Anything based on average true range, I think, is where you eventually want to go. A percent stop, a moving average stop is a percent stop is the easiest but least effective because at least it just gets you out before you lose too much. A moving average is good because it's a little more dynamic, but it's not as dynamic as you probably want it to be. Average range is good because that is a dynamic stop based on the normal volatility of a stock. That's where I would ideally get to. That was a long-winded answer to your question, but I hope that you found that to be a helpful one. And that has now taken us to the end of the show. Folks, thank you guys so much for some really thoughtful questions. I didn't get to all of them, but the ones I didn't get to, I will put in the mailbag. Don't forget to tune in. Tomorrow, we'll be doing an all mailbag episode. Be aware it's going to become at some random time tomorrow because my son, who plays club soccer, and we have to travel all around the Pacific Northwest, we're playing down in Puyallup tomorrow. It's a 3-day tournament. We're kind of commuting back and forth. Puyallup is way down by Tacoma. That is not close to Redmond, Washington. So I'm going to be driving around the Pacific Northwest over the next couple of days, but I will get an all mailbag episode and I will let you know when it's out. Between now and then, I say have a fantastic night. And remember, it's always a good time to own good charts. Take care, folks.